Hello, and thanks for joining the Deal and Donnelley Financial Solutions, the State of Private Equity, Current Trends and Outlook webcast. I'm Daniel Perez, Director of Business Strategy for Venue, Donnelley Financial Solutions virtual data room and end-to-end deal solution suite. Last year, while the number of private equity-backed buyout deals increased globally, according to Preqin, deal value actually declined by 25%. Now, in 2017, private equity firms continue to face high multiples amid tough competition from strategic buyers. Now, at the same time, firms are navigating a period of uncertainty, much which may be stemming from the new administration in Washington, Brexit, and many other factors facing the market. Joining me today to discuss this and much more are Andres Sáenz, Managing Director and Co-Head of Private Equity at Parthenon EY, Richard Prestegard, Partner of Business Development at High Road Capital Partners, and Shamit Grover, Managing Director of Private Capital Group MSD Partners. Now, we'd like everyone watching today to be part of today's conversation. So throughout the hour, please submit your questions just to the right of your browser. So let's get started. So Andres, how would you describe the current deal-making environment?
I think you alluded to it in your intro, but the word that comes to mind is competitive. You have dry powder at near peak levels. I think depending on what sources you look at, it's over $500 billion of dry powder that private equity firms have. Puts a lot of pressure to put that capital to work. Which consequently leads to more competition and high valuations, high multiples on the buy. On top of that, you have the strategics, which have cash. They're looking for inorganic growth opportunities. And they can put in winning bids on the basis of post-deal synergies. And I think if you look at the private equity space generally, the definition has broadened as well. You have pension funds, sovereign wealth funds, family offices, all competing for those same deals. At the end of the day, if you look at the metrics, private equity continues to be an incredibly robust and successful sector. But if you double click a little bit and you look at the balance of power within the space, ultimately, it's still a seller's market today.
Mm-hmm. So Richard, how would you say the environment compares to last year?
Well, it continues to be tough and, to use Andre's word, competitive market. And I don't see it getting less competitive. And if anything, it's going to continue to get more competitive. But that doesn't mean that there are not opportunities to be had. It depends a little bit on whether you're looking at the larger end of the market or the smaller end of the market. My firm at High Road, we're focused on the smaller end of the market. We continue to see very robust opportunities. There's more opportunities than we can see, frankly. So while I hear my private equity brothers and sisters talking about how deal flow to start the year in the first quarter is generally down, we've actually seen it go up, at High Road. So I think it just continues to be challenging. Last year, volumes down 12%, values down 12 to 15%. I think that, you haven't asked us to bring out the crystal ball yet. Maybe you're going to ask us that later, but I can see more of the same this year.
Okay, great. So Andres, can you comment on entry multiples that you're seeing and where they might be headed?
Sure. I mean, they're still very high at the end of the day. I mean, again, near peak levels, 10 times plus multiples out in the market. There are certain sectors that are driving that more aggressively. You look at the tech sector, you look at life sciences. Some of these sectors are certainly driving a little bit more. Going forward, I think to some degree there's some uncertainty in the marketplace as to where those multiples will go. Although I will say when we talk to our clients, they're certainly not baking in multiple expansion as it pertains to their investment case. Very, very focused on value creation and ultimately making the deal work. Because things are very, very competitive. And as we were talking about how it's trending over time, we get called in to advise our private equity firms on diligence, et cetera. And it's interesting as the competition has increased, the number of start-stops that we have as a firm, the number of people who are trying to front-run a particular deal. It feels very choppy for the private equity community trying to chase these deals as there's so many people trying to jump in on them. So.
Yeah, and I think again, 10 times multiple is kind of what's referred to right now as the median or average multiple for clearing a private equity buyout deal. Again, that'll depend a little bit on the size. Obviously, that's an average, so we see deals all the time that we're told they're going to trade at much higher than that, 12 to 15 times, even for small companies. But in general, I'll keep adding some color to what's happening at the smaller end of the markets, given that's where we see most of our activities. It's less than that. It's probably an 8 times range to clear on average. GF Data is a nice, interesting data resource that aggregates deals up to $250 million. So we find that's a good resource, and they're showing about 7 or 8 times, I think, as a clearing multiple at the smaller end of the markets.
Yeah, and I would say at the mid-market and above, it tends to be 10 times is deemed a floor, even for assets which 2-3 years ago used to be 7-8 times assets. Anything that's sizable and chunky and can take a lot of capital, just given the desire for people to put capital out, given the dry powder that Andres mentioned, that's sort of the entry price for basic assets, and anything that has any reasonable growth to it. You probably saw the tech volume is a lot higher. That's partly because there's a lot of growth in those assets, and those assets are teens and at times high teens in many cases, both not just strategics, but even private equity sponsors at the large size.
Right. Great. So, Shamit, let's stick with you. In the intro, we talked about the high valuations and the tough competition from strategics that the firms are facing. Can you comment on how they're actually navigating that environment?
Sure. It's a couple of things that Andres alluded to. There's a lot more organization around the capital. So number one, there is competition from strategics, but the private capital universe has expanded as well. Right? There's private equity of all different sizes. There are the long funds now within private equity. There are family offices that are getting more organized. There are pension funds that are getting more organized, sovereign wealth funds. So not just strategic competition, but competition from a number of different providers of capital. As a result of that, there's been, as with any industry as it starts maturing, there's more specialization and there's more concentration and organization around the industry. So in our industry as well, there's just a bigger focus on trying to figure out where do you excel. Is it information services? And where within information services do you have a better ability to go create value in a certain asset? Then line yourself up with resources, both in terms of advisors, but also executive resources, to be able to find differentiated views on assets well ahead of those assets coming to market. So pounding the pavement, finding 12, 18 months ahead of time, opportunities that you can develop. And then when you get into the actual process of trying to buy the business, having a clearly articulated view of how you're going to create value, whether it's M&A strategy already lined up, whether it's 3 or 4 operational initiatives you want to do. So in sum, there's just a lot more focus on where you should be playing and how you should be playing, and that's allowing certain firms to compete better in this marketplace.
Yeah, I mean, I think part of what we've seen too with some of our fund clients is there are different types of funds that they're raising. So long life funds as one vehicle to tap into a part of the market that maybe they weren't going after. We've seen special situations funds when you think about more operational value creation, balance sheet transformation, opportunities that they may have there. Much more propensity to think about take privates, again, as another way of creating deal flow. The other one that's interesting, and you may be seeing that on the lower end of the market, Rich, is we've seen some of the larger funds trying to come down market to find the deals. And so always the trick with that is how do you deploy enough capital to make it make sense for your firm. We've seen people create these holding companies and say, well, listen, I'm going to get a CEO, I'm going to have an infrastructure in place, and I'm going to assign a significant pool of capital, and we're going to go do smaller deals that are in this space and sort of cobble them together and create a platform from that. So just getting outside of their traditional comfort zone to find deals in this more competitive space.
Yeah, actually, thank you for pointing out an annoying trend of larger funds coming down market. We do see that, and not only does that happen, they're thinking about dollars getting deployed.
Right.
And to them, it might be a higher multiple, but it's the same dollar amount. It's a dollar amount that they want to deploy. So they're thinking of it that way, and then think of an add-on strategy that will average the multiple down over time and deploy more capital. So we're seeing very aggressive behavior from the larger funds doing smaller deals now.
Now, are you seeing any specific sectors or industries where this is more prevalent?
So I've seen a couple of examples in the consumer space, for example, because I think there's a commonality of investment thesis, and you have management teams that you can put together that have a good view of certain brands in a certain space in a certain subsector. Although I do think Shamit's right. I mean, at the end of the day, that specialization, not even around sector, but really around subsector, and saying we're going to own this and we're going to go fight for these deals and we're going to be ready for them by having that infrastructure, is where we're seeing a lot of that. So
we've seen it in healthcare, where healthcare providers are being acquired, and there's this, I don't know if this is an actual term, but it's a term that we use, or I use, retailization of healthcare providers like dermatologists and eye care. So there are very big multiples being paid for what's considered a platform company in that space, and then it's a good strategy. There are lots of small mom and pops, providers out there that would benefit from being part of a larger organization. And there are a couple of firms out that are just doing a great job at targeting that as a market where they can deploy this kind of strategy.
Right. And in fact, I would say the consumer space has a similar dynamic, and in fact, consumer-driven in that you have these trends around folks looking for authentic, local type brands, and those cater to innovation and smaller assets. And so if you can take those, professionalize them, but still keep that underlying sort of root demand for the consumer, it makes for a very attractive investment platform.
Yeah, we're seeing it across industries. I'd say only within the large industrials complex where there's already a reasonable amount of consolidation. That's a little bit less so. But within industrial distribution, there's definitely the platform strategy being deployed. And then perhaps in media and entertainment assets, again, certain parts of it, there's not necessarily that many opportunities from a consolidation standpoint. But outside of that, we can go industry by industry, and that's a fairly recent focus area for people. Buy platforms and do tack-ons to try and get more capital out of the door and pay up for the platform to start with.
So sticking with creative ways for navigating the environment, what are some different ways that PE firms are deploying dry powder?
Yeah, it's some of those things we've talked about. One is trying to do these platform deals and tack-ons with those, where you have an operator that you're backing to go build up a business. The second is out of the gates trying to do a combination of two companies at the same time. So if you're trying to deploy capital into $75 million EBITDA businesses, try to buy two with 40 and 35 is one way to get to 75. So we're seeing a little bit of that. And then the third one is carve-outs. So people are getting more and more focused around trying to go beat the door down to the large industrial conglomerates or technology conglomerates and seeing where you can pull some assets out. So I would say those three are probably where there's a lot of energy being spent.
I'd add one to that, I think, that we see especially prevalent in the smaller end of the markets, and that's using earnouts. When sellers, which is happening, sellers are better educated today, the whole system is basically more efficient. Sellers have an awareness of what businesses are trading for in their respective niches. And if they catch wind of that in the locker room or wherever from their advisor that they should be trading for 9 or 10 times or something that's way too much, frankly. They have expectations of where it's going to trade, and you may have an additional hurdle to getting a deal done. So earnouts are a way to kind of bridge the gap where they maybe haven't proven out their model as much, where we as a buyer would feel like they should get a 7, 8, 9 times multiple, whatever the number is. I do think that earnouts are becoming more of a way that it's not as clean. It's not a way that I think anybody really prefers to structure a deal, but it is a way to kind of bridge that gap, especially when multiples are higher.
I'd say a couple of things as well in terms of the method. So one is the types of deals you're doing, and the other is the methodology in which you're doing the deals. And the methodology, there's a couple of other tools people are utilizing a lot. One is bringing the junior capital to the table themselves. So the mid-market, being able to go find, whether it be preferred instruments or find second lien with some of the larger Canadian pension funds, for instance, and being able to deliver that to take away deal certainty, or to add deal certainty, take away deal risk, is one approach people have taken. The other is maybe get into a business on a minority basis. So if there's no institutional capital in the company, or it is in fact sponsor-owned, go in and do a minority investment, get to know the business for some period of time before you do the actual control equity transaction. So those are two other methodologies people are trying to employ.
Got it. Great. So, Rich, can you comment on some of the trends you're seeing in deal financing?
Yeah, sure. There's probably not a whole lot new happening in deal financing, other than one thing probably, which is the proliferation of funds having their own lines of credit, which they can draw on prior to close or to fund a closing of a transaction. that takes a lot of things off the table in terms of time to close and having to run around and call capital and a range of lenders. You can fund it faster that way, and we've seen that used as a competitive weapon in a process whereby I think most firms, if they don't already have a line of credit in place, they're probably thinking about it right now and saying, Rich is saying we should go do that, and they're going to maybe go do it. So that's kind of a newish thing. It's been around for years, but it's become something that's more vogue. Leverage is high. We've already talked about that, and I think that we're starting to feel maybe a little bit of weight on the top of the leverage ratios. Last year, I believe, from PitchBook, I saw statistics saying that it kind of flattened out. It depends on where you are again in the size spectrum, but I think overall, where we see leverage topping out for deals of our size range, that is kind of like up to 100 million enterprise value. It's 4 to 4.5 times total leverage number. But what's happening is while valuations are going up and those leverage multiples are kind of topping out, you're starting to see more equity getting put into the deals. So with an average of 10 times enterprise value multiple, the math is simple enough for that's saying that if you're having, on average, I think leverage multiples for the whole is probably up to 5 times. You're talking about 5 or plus times equity value, a little bit over 50% or a little over is being contributed to deals by equity. So I think those are kind of the 3 things that I wanted to touch on anyway, as far as how things are getting financed. I don't know if the guys have anything to add to that. The earnout is another way that gets put into the financing equation as well.
Got it.
Yeah, so the larger end of the market, we spent a lot of time in the last year and a half focusing on structured capital, because about a year and a half, 2 years ago, there were leveraged lending guidelines around what the banking institutions could do from an ability to lend above 6.5, 7 times. With multiples trending towards double digits into the teens, there's a much larger equity check required. So on the one hand, people have more capital to deploy. They also don't want to have 6 turns of equity in every deal that they're doing. So some of the transactions we did last year in terms of recapitalizing TNS, providing a structured financing into UFC, providing a structured financing into WCG, all very different businesses. But the need there for the capital was the banks top out at certain leverage levels. We also made a seed investment into a BDC, a debt BDC called Owl Rock, and there we see the trends of how the banks are being disintermediated by all the entire BDC world. And the financing is still very available, and the terms are definitely covenant light in the mid-market today. But there are some needs for creativity around the second lien and the junior capital, where flexible capital can actually create an opportunity out of it. And for private equity, you have to have the savvy, your own debt capital markets guys, for instance, to be able to go procure that capital and be able to deliver the certainty on a transaction.
Got it. Interesting. Wow. So, Shamit, sticking with you, how will a rise in interest rates affect transactional activity?
I'd say it's not a there's not a linear answer, right? It's if rates are rising because the economy is healthy, that means growth rates are better. So valuation should be supported by growth rates, taken down by interest rates. What's going on today? We've studied this over the years. What really drives deal making and deal activity tends to be more dry powder than anything else. Like if I have a 5-year fund and I need to go deploy it, I'm going to deploy it irrespective of what the marketplace is. I can't go back to my LPs and say, hey, I only deployed 50% of your capital. It doesn't justify my next $10 billion fund. So while rates might rise and that might impact multiples, and when we look at transactions, we do assume some level of multiple compression further out. I don't think it's a linear, straightforward, hey, absolutely rates are going to lead to lower multiples. It depends a bit on what's going on with the overall macroeconomy and the amount of capital people have they're trying to get out of the door.
Got it.
Yeah. I mean, I think at the end of the day, you have some puts and takes on interest rate. And to the extent that there are slow hikes, you have a little bit of a hit on cost of capital, but by the same token, corporates may be not as robustly in the marketplace. I think those things are at the margin, because at the end of the day, I think there are bigger secular drivers of why the deals are happening. I think if you see, for any reason, an acceleration of rate hikes, or either in frequency or the magnitude of those hikes, you do start moving the conversation from one around those are happening because of growth. If they start happening because of heavy inflation or heavy budget deficits, that could create a cloud of uncertainty in the market for sure.
So, kind of sticking that idea, I know it's early, but Rich, can you comment on the presidential election, on any impact it's had on deal activity?
Yeah, it is early. I don't think so is the quick, straight answer, but I think it might, and maybe it has to some degree. There are certainly some sectors where, based on the platform that President Trump ran on, and in terms of, reinvigorating investment in infrastructure, for example, I think that there could and should be a great amount of activity there. There has been a fairly high level of activity there already anyway. So whether or not it's really because President Trump is in office, I think remains to be seen. From bankers, anecdotally, they haven't seen the election change necessarily the thought process on behalf of business owners. It's more about what's going on with interest rates. It's more about what's going on with multiples and where businesses are trading generally. I don't think you can point to Donald Trump being elected as the reason that multiples are where they are. They've been there for the last 2 years-ish, I think. So it's more about that. I think business owners have started to feel like, again, anecdotally from bankers and from conversations we have with them directly, started to feel like there's places they can put cash when they sell their business, and that's one thing. There's another thing. There's a massive amount of baby boomers out there that still own businesses that have been holding on to them for the right opportunity, or frankly because they have nothing else to do with their time, but they run out of time eventually, and so. I think we are going to potentially see, an increase of activity here. I'm hopeful of that. I'm optimistic for it, but I don't necessarily think that I would pin it on, who's in office.
Yeah, I mean, it feels that following the election, the sentiment's probably more positive than negative. You have the prospect of financial deregulation. You have the infrastructure spend. You have tax reform. All these sort of things on the table, right? I think as the time passes, I think there's uncertainty as to what can actually be accomplished, and that is sort of coloring the perspective today. I think tax reform is an interesting one because I think any package almost certainly will have some sort of lower corporate tax rate, which should be a positive to the space. There's also the conversation around carried interest. There's a conversation around the deductibility of interest payments. So, I mean, it's uncertain, but these impacts will be important to keep track of and react to.
What about from a cross-border perspective? Any changes potentially, or any areas?
These guys do more internationally than we do. We're mostly domestic focused, but I will say for our portfolio companies, what's happening, the policies that are being put in place is making us, take a closer look at what's going on within our own portfolio.
Yeah, and we have a couple of businesses that we own internationally, one domiciled in Ireland, one domiciled in London, in the UK. And I don't think there are sort of obvious impacts, right? As Andres said, there's a lot of uncertainty. So could I model, what's going to happen if there's a border adjustment tax? Sure, but do I really know what's going to happen with border adjustment tax? Could I model what's going to happen to drug pricing and how that's going to impact clinical trials? Mm-hmm. I can conceive of certain models, but how much probability do I assign to those? So I think on the one hand, it creates uncertainty, and uncertainty creates a little bit of wariness around trying to get transactions done. On the other hand, once one works through some of the models, for instance, if you offset interest rate deductibility with lower taxes, if you offset the realistic likelihood of getting to a border adjustment tax, you factor those in, but I don't think it's necessarily changed people's desire to go deploy capital only in certain very specific pockets. For instance, in healthcare, but some rather radical changes might occur. Can people really pause? So otherwise, it's you assess all those risks in the transaction, and I can't say in the last 3 to 6 months we haven't chased something down, or haven't, on the other hand, proactively chased something down just because of the political environment.
And you bring up an interesting point that I think you might be heading towards asking about, which is sectors that could be of interest. So we mentioned infrastructure. Healthcare is going to be a tough one, I think, but there are pockets within healthcare that I think could be interesting to go to just based on where the administration is going and you know what they're doing there. Like businesses that focus on reducing healthcare costs overall to the system, I think, you know, is a place that has been a popular place to go within the healthcare universe for years. Also, I think, you know, the whole bringing manufacturing back to the U.S. is an important trend that is being supported by the administration, and I think that you know, getting in and investing in Middle America manufacturing is going to be a good place to be. And I would add to that, especially if you're doing something probably on the automation side of it, are a couple of examples where we see, you know, good activity. We're also seeing a lot in building products. There's still seems to be a lot of room to run on home building and just building products in general. I don't know if there are any others that you guys felt like.
Yeah, so we get to see it. I mean, we get to see it in the stats, and then we get to see it sort of across our client base. I would completely agree with building products. I think there is a cascading effect from the promise of infrastructure spend and how you think about growth from that perspective. Likewise with healthcare. I mean, in general, we tend to see spikes when we see disruption, and I think healthcare has been one of those spaces where you get that kind of disruption where people go and then find opportunities. The other one that comes to mind, because we're seeing a lot of it, is technology. You know, particularly on the software side, I think you have a whole generation of vertical software platforms that have gotten to scale, that have a leadership position, or at least a number 2 position in the market, and different than the sort of the .com era of old. They have real cash flows, and in fact, many of them have recurring revenues. So they've become, I think, a very, very interesting set of assets for private equity to jump in on. Again, not surprisingly, we talked about it earlier, that's where you're getting really high multiples in that sector. But we're seeing, you know, very, very sort of focused firms going after those and trying to attack that market. Because it is pretty interesting from a private equity perspective, just as you run the models. Shamit, I don't know if you've seen something different. But.
No, I think it's, I'd say, the areas you highlighted were the ones where there's a lot more activity. And I mentioned earlier as well, technology has been a big area of focus, partly because there's a lot of growth there. So you can get the baseline of stability by virtue of having recurring cash flows, having entrenched customer bases, and then you have the ability to continue to build that business out, because depending on which particular vertical you go into software, many of them are very fragmented verticals, and there's tons of opportunity to grow. And just if you want to pay, or if you have to pay 13, 14, 15 times for assets, you would rather have a very strong base and then ability to...
Glad you changed it to have to pay.
Exactly.
Okay, well, so we touched on disruption and the large funds coming down is kind of driving activity. Is there any other high-level trends driving activity from a market perspective?
I don't know. We've hit on larger funds coming down. I mean, the administration is just, you know, what you always see, you know, sector-specific reasons why there's activity levels.
All right, so...
Yeah, it seems like it's across sort of 2 dimensions, right? On the one hand, I think the bigger funds have the ability to try to do more things, right? Different types of funds, different forms of capital, different geographies, and so you start looking for different areas. By the same token, the game is being played at a level of specialization that we haven't seen in years past. And so you can do that at the horizontal level, but at the end of the day, if you're going to be winning deals and winning the right deals at the right price for you, if you have that level of knowledge and that infrastructure and that network and that idea of how you're going to create value all together. And so I think people are going to get creative across both of those dimensions, I think.
Yeah, and I guess we've said it in other ways, but let me see if this is a bit different. It's the lack of growth, more secularly, is going to drive more need for M&A. So whether you're a sponsor owner of a company or you're a corporate, that's your way to achieve growth. So the sponsor owner, to do a large transaction or do tuck-ins, is your way to earn a return when you have to pay 13, 15 times for assets. So that's aside from dry powder, all the different parts about having to get that capital deployed, the nature of the macro environment today is also very supportive of doing a lot of M&A to drive value.
Okay. So then what about exit strategies? Are there any that are more favored by portfolio companies? I mean, PE firms for their portfolio companies?
Yeah, I think in general for us, the preference is always a outright sale as opposed to a public offering. The last year, depending on what part of the year you look at, or going back even 4 or 5 years, there's been periods and times where the IPO markets have been very attractive, but there have been periods of times, like early part of last year, where the IPO markets have not been as attractive, especially for levered companies. So anything that's got 4.5, 5 tons of leverage on it tends to not find a lot of favor from an IPO perspective. Strategics, to an earlier point that was made, tend to be able to pay higher multiples because of all the synergies that derive. So if I can sell a portfolio company to a strategic and get an extra turn or two of multiple expansion, that's obviously very helpful. So I'd say an outright sale is the preferred path. With the IPO, for a certain size company, that's the right outlet, but it's an outright sale is definitely the preferred path.
For us in the smaller end of the market, an IPO is not typically a viable option. So it's almost always an outright sale. And then we're relatively indifferent as to whether or not it's another PE firm or a strategic. You probably start out the process of what you're going to do for an exit with a strategic thought process, just because of what Shamit was saying, and that they're typically got a higher capacity to pay. But we're seeing that less and less these days. Private equity firms need to get their capital deployed, and there's a limited number of assets that are available. And as Andres said, it's good to be a seller right now. So an outright sale, I'd say for us at the smaller end of the markets is almost the only way to go.
I'd say the one difference for us, given where we sit with sort of one large pool of capital, no real funds to drive exits, right? We don't raise funds. We don't sort of have to exit businesses. We do exit them. It's a flexible time horizon. A lot of our decision making around the exit also is what's the best thing for the business. If there's a strategic fit, we had a transaction where we took the largest landscaping company in the country, combined with the number 2. KKR owns majority piece, we own a minority piece. We took back a whole bunch of equity because that was the right thing to do for the industry structure, for the teams on the table running the businesses. Mm-hmm. In other cases, we sold a timber asset 10 years ago, and we sold it to a strategic as well because the team could run a much larger business. So it depends a little bit on the dynamic of the company as well as to what's the right answer for the business and what's the right answer for the management team.
I will say we are seeing us at the top end of the market. The strategics in the last few years have been a very, very sort of good landing spot for PE exits. I think over the last few years, over 70% of PE exits go to strategics, which I think is much higher than it was 5-10 years ago. So I think you start out with that sort of investment case. It doesn't always work out that way, and private equities will try to wedge themselves into that conversation for sure. But they're pretty dynamic and on top of it right now.
So last year we saw fundraising continuing strong with 807 PE funds globally wrapping up fundraising at almost $350 billion. What are we seeing this year in terms of fundraising?
Yeah, I mean, listen, it's good to be a seller. In general, it's a good time to be raising funds as well. I think year to date we've seen probably the same level of success in closing funds. We talked about the dry powder, so we know there's a lot of, if you want to call it that, excess capital out there. But probably the biggest driver, the root driver here is there's a powerful secular force around putting money into private equity. If you look at the pension funds, they have to deal with funding gaps. One way to bridge that gap is to look for alternative assets, including private equity. If anything, they can't meet their own allocation target of how much they want to put into private equity. I do think that sends some of the capital probably disproportionately into the larger funds. Even if they recognize that there might be higher returns in different types of funds, they have to deploy a lot of money. The institutional investors are trying to deploy a lot of money at once, and they are trying to lower the complexity of managing that money. So a lot of it does go ultimately into those mega caps. But I think, notwithstanding the dry powder, and certainly economic conditions are favorable, but as private equity returns continue to be projected to be higher than public market returns and fixed income returns, you're going to see money flowing in.
I'd say it's sort of, we're not in the fundraising business, but I am involved with the investment committee at my college, and so we see the trends from an LP's perspective there, I guess. A few things. One, there's been more distributions out of private equity than there has been deployment in the last couple of years. So a lot of the 06, 07 vintage deals were working their way through the system post the crisis. So there's been a lot more distribution in the last couple of years. So just the sheer amount of capital that's been deployed in private equity has reduced as a result of that. Second, the denominator is higher, which is public markets are up, so the percentage of assets you have deployed in private assets has just mathematically gone down. Third, to some of the points that were being talked about, there is an illiquidity premium, and statistics show over many, many cycles, 3, 5, 10, 15 years, private equity is a better asset class. So when you combine all those things, people have a lot of desire to put money towards private equity, and hence the fundraising environment, from everything we can see, while not being in the market, we see it being pretty robust.
Got it. Interesting. Okay. So then what is your look on first-time funds?
That's an interesting thing. So this was actually a debate we had very recently, and what's happening is the larger capital sources have better access to first-time funds. The smaller capital sources, so I went to Harvey Mudd, it's a small engineering school, leading engineering school, but small, $250, $300 endowment. We don't have access to Blackstone Fund 8 and KKR Fund 4, whatever it might be. So we have to think of creative ways to get exposure to the private equity asset class. And one of the ways to do that is first-time funds. And what's finally starting to happen is the advisory industry is starting to organize around it. So Cambridge Associates, one of your neighbors up in Boston, they have a much bigger focus now on first-time funds than they've ever had in their history. And that's because, one, for smaller LPs, getting access to an asset class that they've been trying to get more access to. And then two, for the larger LPs, trying to get some alpha, right? Mm-hmm. If you are the guy who's plowing a bunch of capital into all the larger funds, your returns are going to look like everybody else's. So how do you generate some alpha? So there has been and I don't know the statistics around it specifically, but my sense from all the conversations has been that the first-time fund activity has been more robust than it has been in many, many years.
Yeah, it's about, I happened to look it up before coming out. It's about 10%, I think, last year was of the funds raised and closed last year were in first-time funds. And I find that kind of fascinating, being at a firm that raised our first fund in 2007. I don't know what the percentage was back then. I didn't have a chance to look that up, but I'm quite certain that 10% as a percent of the total is higher today than it was back then. This is another annoying trend, I think, because the smaller funds are competing with us and they want to get their capital deployed. I think it's tough going for them, though. They're going to have to produce a track record of returns in an environment where valuations are very high. And competition is very tough. You know, they have to have a track record already from wherever they were previously in order to raise the fund. So they have some of that, but now they've got to go and prove it in their model as a new fund. The funny thing, or the tricky thing about our industry, is you don't really know how that's going to work out for another 3 to 7 years. Right. So we'll see.
Right. Although I will say, I mean, from what we've seen, in general, first-time funds tend to outperform the average, and you know, and I think some of it is because the folks sort of leading up those funds have a personal track record, have a set of relationships, et cetera. But I think probably beyond that, given where we are today in the market, I think there's an element of, first of all, they're usually going after lower sized deals, so it's less competitive from that perspective. Obviously, you have a highly motivated GP, you know, trying to get deals done. And there's just an element of focus that we find pretty interesting. And when we look at these first-time funds today, especially relative to first-time funds 10 years ago, they are incredibly focused. And their story is incredibly focused as to what they're going after and where they can really add value and how they're going to return capital.
So shifting away from funds and looking at activism, Rich, can you comment on if you're seeing an increase in the number of PE deals resulting from divestitures by activist targeted campaigns?
Yeah, sure. This could be a little quicker answer, but yes, I think so. We don't see a ton of deals in our size range that are divestitures of large public companies where an activist would turn their attention. It has happened. It's not a statistic that I track specifically. I know that carve-outs are up. I can't say that that's because of activism. It could be proactive before activism happens. I think there's a chance that that's driving some of what we're seeing in terms of carve-outs and divestitures. But I can't say actually specifically to answer your question that activism is driving the higher activity levels. Probably, but I can't say it for certain.
Yeah, I mean, I think that there is probably a natural tendency as you think about activists to, push, as they push for sort of better management, non-core assets getting divested, which creates opportunities for private equity. I do think, and this is partly embedded in what you were saying, I think private equity broadly views activism as creating opportunities for them, period. Because as you think about folks out there selling their company, it may be the threat of activism may be pushing them into the private equity space and finding that form of governance something they're happier to live with.
So, question for Shamit and Rich. How many potential deals does your firm look at in a given year?
You want to go first, or?
Sure. I'd say last year, then again, it's the top of the funnel versus how many are sort of towards the bottom of the funnel, right? So last year we probably came across 200 plus situations. And again, we have two lanes. We've got control equities focus, and we've got a structured equity focus as well. And so across those two, there were probably 200 plus situations that we engaged upon to some degree, but again, you can't engage on 200 situations substantively. And then way down the funnel, we probably, and again, we tend to stay out of the sealed bid auction process market. We're much more in those situations where somebody differentially requires our capital. We probably spent time on 6 or 7 opportunities where we were actually doing due diligence, negotiating with the counterparty, and we closed on 4 of them. So top of the funnel, very broad, 200. Bottom of the funnel, 6 or 7 opportunities really, where there was substantive engagement with 4 that we closed upon.
Yeah, so you're going to get a good highlight of 2 very different models as far as how sourcing goes. And it's a function of focus, and it's a function of size, frankly. And so with us focused on deals that essentially are $3 to $10 million of EBITDA, we're talking about the small end of the market. And if you think about a transaction size, it's up to 100 million or so. PitchBook, I think, breaks their 2 lower market categories down to 2. I think the top is 100 million, or maybe it's 200 million. I can't remember. 2,500 deals transacted last year. So it's a very vast and broad market there. And frankly, it's more than that because a lot of the transactions that happen at the small end are so private and don't get picked up. So our approach has always been cast a broad net. Our top end of our funnel, we're built for efficiency and really trying to see as many deals as we possibly can. Many of them come from the intermediated market, but we also do all the other things that we'll talk a little bit more of if we still have time. But so a top end of our funnel is 1,500 to 1,600 deals got logged last year that met our investment criteria for platforms or were add-ons. About 15% of those were add-ons. And then I won't go all the way down the funnel, but for deal books where we spend a little bit more time on, just to give a little more color around it, was somewhere around 500, a little over 500. So it's pretty, we look at a lot of deals.
So are there any interesting strategies that you guys look at for increasing deal flow?
Well, I mean, for us, I'll go first on this one. For us, it's really been about an exercise over 10 years in building efficiency and trying to continue to make what was started out as a broad net and making it broader. We started out focused on really pretty much just bank deals, and I kind of look at the world now as channels of deal distribution. So that's one channel where bankers are banking deals, but now you've got deal aggregators where they've become much more prevalent in the Axials and the Deal Nexuses of the world. They do a much better job in doing what they do. You've got the alternative advisors, wealth advisors, consultants, lawyers. That's a whole other channel where you can spend time. So our strategy has been to more or less, get as efficient as we can in getting through and processing bank deals and having very good relationships there, but trying to find ways where we can get into these other channels. Independent sponsors is another one. We want to see deals that are right for us from any and all of those channels.
Yeah, our approach is very much driven by a philosophy around deep dives. So every year we sit around the table, all 8 of us, and debate which particular themes are most interesting for us. Whittle it down to 6 themes. Each MD has 2 themes they're proactively chasing down. So for instance, this year, one of the themes is the education space as a broad theme, and it could be education technology, education services, K through 12 or otherwise, and align ourselves around those themes. So around that, We'll develop relationships with executives, we'll develop relationships with intermediaries. But again, trying to find those situations where somebody differentially cares about our flexible, patient, permanent capital. And so start at the funnel in terms of industries, get a real angle on the industry, get a real view on the industry, and then try to find those situations where somebody differentially cares about our capital, whether it be structural capital or controlled capital, whatever the case might be. So the entire process is much more deep dive driven, and it's been very successful for us over the years. 2008, 2009, we deployed over $500 million in financial institutions, not having done anything before in that space. 2011, 2012, we got focused on aerospace, made a helicopter leasing investment. We've been very focused on the music payment space. We've been very focused on live entertainment, made an investment in the UFC. So it's very much driven by the thematic deep dives.
And I'll tell you, Shamit, we've seen that approach being much more aggressive within our client base. So being very proactive at what you're going after. So as you think about sector, breaking that into subsectors, there's an investment theme that they can really get conviction around. Finding the bankers, going to the trade shows. I mean, it comes to life for us. Ernst & Young sponsors the Entrepreneur of the Year program. And there is insatiable appetite on behalf of our private equity clients to be judges on those things, to attend the event and meet the folks, because they've identified subsectors and are trying to go as deep as possible in those relationships, get to know the future CEOs of those companies, find the companies, et cetera. It is, and it's not so much like in the olden days to try to find a proprietary deal within that. It's to find an angle. It's to find an angle to somehow, whether it be because of the nature of your capital base or because you have a point of view around value creation, to force that sort of into the equation and get yourself into the winning bid.
And it's a very interesting approach because you get to connect so many different dots, right? So why are we in this business? We enjoy investing in businesses and helping them grow. And if you can sit down with an entrepreneur, with a manager, with a founder, spend time with them, understand the business. So frankly, while it increases deal sourcing, creates focus, it's frankly just a better, fun approach.
Oh, great. So at Donnelley, we actually have a deal sourcing offering, and I know you're familiar with deal sourcing. So how has private equity deal sourcing evolved over the years?
Well, it's changed a lot. Deal sourcing itself has gotten much more competitive, along with just the general overall tone of the industry. I tell a story of how when I joined High Road in 2007, it starts first on the sourcing front itself. There were probably around 30 firms or so that had dedicated deal sourcing. I don't know if that's the right number, but that's the ballpark where I put it. And today there's several hundred of them. So on the firm front, things have gotten more efficient. There's more focus on keeping pipelines filled, and that's helping keep things more competitive. Then on the distribution front, there have been changes there as well. Your platform, there's the two that I mentioned before, the Axial and the DealNexus platforms, are also very robust, and they started, I can't remember how many years ago now, 5 or 6 years ago, and they really do a great job for what they do. So there's better ways to distribute deals. I think bankers also just on their own have gotten kind of more efficient in knowing who the right buyers are. They don't necessarily have to show deals to more eyeballs. They know the right eyeballs to look at them and connect them and get a robust process out of that. And then lastly, I think business owners are also more intelligent about what their opportunities are and alternatives. And you don't see always, when you walk in and meet a business owner, someone saying, "Tell me about private equity," which is what it was probably 10 years ago, more times than not. So I think it's all a part of the process. Everything's gotten a little bit more efficient and more competitive today versus 10 years ago. And it probably is going to continue to be that way. Mm-hmm. But there are still great opportunities out there, we think.
Yeah, our sourcing platform actually is a partnership with Axial, and we're just seeing more and more people every year just jumping onto it. So it's been an interesting space. So Andres, can you comment on some of the themes for private equity in the year to come?
Sure. I mean, I'll get us started because it's probably a fantastic list. But I think it does start with sort of the geopolitical climate. I think that is more volatile and uncertain than it has been in years past. And so the impact that will have on macroeconomic conditions and interest rates and also a lot of the things that we've discussed today, I think private equity firms will have to thread the needle of sorts. On the one hand, I think you want to remain steady when appropriate and as appropriate, but also be nimble enough to find the opportunities for investment and to sort of pivot the firm where you need to based on some of these changes. So I think that'll be interesting to watch and monitor and react to. The other one I think we've largely talked about, which is, what is the effect of this dry powder, high competition, high multiples world? And what we're seeing is, and a lot of the push and the active thinking on our fund clients is, how am I going to optimize what we do across the deal life cycle? So what is the best way for me to think about origination and deal sourcing? What is the best way for me to differentially diligence assets to put myself in a position to win? Heavy emphasis on how do you think about operational value creation to make the deals work, and then being much more thoughtful and deliberate than in years past about exit. So there is a sort of rethinking around how much do they need to innovate and optimize across that life cycle that is probably more focused than I've seen it in years past.
I mean, I'd largely agree with everything Andres said. I think you got to look across the whole life cycle of the deal, and that to me is the thing. You got to see improvement in every way, starting at the front end with deal sourcing, going to once you own the business, your operating partners are earning what they get paid, to make sure that the companies are performing at a level that is expected. And then you've got to be really smart about how and when you exit as well. I think that more than ever with the competition the way that it is, those are going to be things that everybody's going to be focused on.
Yeah, I think it's about differentiation, right? If you have 40 people courting every CEO, and CEO will eventually get lost in those 40 people, will not know which one is a good partner long term. So how does a investor create differentiation so that you can deliver on a partnership with a CEO, with a company over 5, 7, 10, 15 years? And that, in some manner, requires a little bit more focus on sourcing, a lot more focus on operational excellence and partnership with the team through the ownership cycle. And again, some people have it, some people don't, and there are different ways to go at it. Differentiation in terms of just the capital base, right? And the networks that the capital brings with it. So those are, I think differentiation is going to be the key theme, because anytime you have a lot of capital chasing few opportunities, you have to have some real differentiation.
So, much like the obligatory U.S. election question, I'm going to ask a Brexit question. So this week, actually, Britain announced that they will trigger Article 50, allowing them to leave the EU on March 29th. What effects do you think this is going to have on deal activity, both in Great Britain as well as other countries?
Sure. I mean, listen, we already saw some effects, I think, leading up to and following the vote. There was a disruption in the deal volumes in the UK. It picked up a little bit afterwards as some of the deals that were put on hold were ultimately done. But I think as it pertains to the triggering, in large part, I think Theresa May had announced that it was going to happen in March. So there's probably no surprise there. And from that point on, you're going to have a 2+ year negotiation around how the UK, what terms are the UK and the EU going to collaborate and trade on. And I think the effect of Brexit will be largely determined in that, in basically how much access the UK has to the EU single market. And the farther and the more constrained that access is, then probably the bigger the impact on UK economic growth, and as a corollary to that, deal making as well. And then you put on top of that situations like the potential Scotland referendum, et cetera, that can exacerbate the impact on the UK. And that, again, largely a UK set of impacts and phenomena. I think the bigger impact on Europe is likely to come from, or potentially would come from, the French presidential election. Marine Le Pen, extreme far right, wants to take France out of the Eurozone. I think the EU can survive without the UK. I think there's a real question as to what would happen if France were to leave from that. Polls right now have her going into the second round. And then after that, the moderate right and the center and the left would all coalesce and ultimately beat her. But I think if we learn anything over the last year or so, is that polls can get it very, very wrong.
So we have a few minutes left, and I do want to offer up a couple audience questions. So the first one, With the affluence of social media and the manner in which activists are using such, do you foresee any challenges in this regard, especially when considering energy-related companies? Anyone want to tackle
that? So, I mean, I'll start.
Okay.
But, and this is perhaps not answering directly, but we are seeing the active management of the funds in terms of their brand, their investment profile, and how that translates into the portfolio companies much more aggressively. So as social media expands, as they think about responsible investing, we see funds coming up with impact investing funds, et cetera. There is a recognition that the controlling of the message is much more widespread now. And that they have to be actively and deliberately managed as opposed to necessarily be reactive to it. I think it's early days on that, but it's not just energy investments. It can be across a whole host of healthcare investments. It can really derail a situation for a private equity fund, and so they're being very, very mindful of that.
Yeah, I mean, I would agree with that. Social media and its impact is a relative wild card still. It's an important part of the universe now. We at High Road don't spend a whole lot of time worrying about it still today, but we're spending more time thinking about it and trying to figure out what's the best way to manage it and monitor its impact. I agree with Andres. I don't think it's sector specific. I think you're open to, issues no matter what sector you're getting involved in. Energy is just one of them.
Interesting. So let's take one more audience question before we wrap. So with regard to international activities by US-based companies, any thoughts on how general data protection regulation and privacy shield impact deals, especially with uncertainty?
Again, happy to start on that. I mean, we have a significant effort within Ernst & Young around cybersecurity and data protection and risk mitigation across those things. And I'll tell you, it is a top-of-mind topic at the top of these private equity firms as they think not only around their deal processes, but certainly once you're sort of within the portfolio, that data privacy, data protection, absolutely critical for them. And it's not just on the usual sort of front page news type holdings that one could have around retail credit card, et cetera. It is much, it is applicable across, and again, not only their enterprise, but the portfolio, all the portfolios. So a very, very relevant topic.
Yeah, and we're seeing it both in terms of portfolio companies, our own business, from a management perspective, but also as a potential team that you can invest behind. So I can't recall there was a transaction done in the last couple of days. Vitruvian bought an insurance brokerage or insurance business in the cybersecurity space. There are other companies that are able to help other people figure out their cybersecurity needs, manage policies, things like that. So we think of it more as a team. But yes, at the very basic level, making sure our portfolio company and then we ourselves are protected against that is something we spend some time on.
I mean, I'll say the obvious. Cybersecurity is a good investment area, given what's happening, and that's how I think about it. And looking for ways that cybersecurity and compliance is impacted by these issues that are coming to light.
I'm not sure if it'll have an impact directly, and I'm not too familiar with the legislation that's being referenced. I'm not sure if there's a direct impact on deal-making activity. It's potentially more on your side of the business where people are utilizing data rooms more and making sure that there's adequate levels of protection. But I don't think if you had to go back to rooms with papers filled in it to make sure data is secure, we'll go back to that.
Let's hope not, for our sake.
Exactly.
Well, I want to thank the panel for joining us today. I've been speaking with Shamit Grover, Managing Director of Private Capital Group, MSD Partners, Richard Prestegard, Partner, Business Development, High Road Capital Partners, and Andres Saenz, Managing Director of the Private Equity Group at Parthenon EY. Thanks for joining us.